So Mark, what do owners of large pools of internationally invested capital need to think about when it comes to currency hedging?
Well, if you have exposure to currencies through international investments, then essentially you have risk, and if it's unmanaged, then you have no expected return. So as we said on the previous video conversation, the dangers of doing nothing, bad things can happen from that. So the notion and the idea about hedging is simply to mitigate that risk and manage it in a better way, or even eliminate it by having a full hedge. But the complexity comes with the notion that currencies are inherently cyclical in nature. So there's a time to hedge and there's a time not to hedge if you want to improve upon any static position. So one needs to think in a more active fashion, I think.
Do you believe that there is such a thing as an optimal hedge ratio?
Well, this is the Holy Grail. And there's been a lot of academic research for decades looking at this question. But essentially, it's time dependent, any of that analysis, because as we've said many times, the regimes change, currency behavior changes. But you do have that inherent cyclicality, and because of that nature of currencies, there is no real one optimum hedge ratio which one can stick with and have the best outcome at any one time. So the Holy Grail, unfortunately, doesn't exist.
Presumably you meet investors who have different philosophical approaches to currency hedging. What's your approach to the challenge of managing currency exposure?
In terms of our belief that the adaptability is key, I think, and we can show, given the evolution of any particular base currency, that the ambition to raise that hedge ratio during periods of base currency appreciation, to lock in that value and not get hurt by the depreciation of foreign currencies, or alternatively reduce that hedge ratio to benefit from the translation effect of those foreign currencies rising, is an ideal which is worth pursuing, and it's also achievable, and therefore you get better results from a dynamic hedging approach than you would do by any static or passive approach.
I imagine that some clients simply want to get rid of currency risk and therefore prefer to employ a 100% hedge of their foreign currency exposure. Is there a logic to that?
Well, there is an argument which says, I have this risk, I have no expected return. If I hedge it all away, I don't have to worry about it. That has been tried many times, but there's a problem with doing that. If you have a fully hedged position and the currency declines, there's going to be a significant loss in that hedge, and there's going to be a cash flow consequence as that hedge is rolled over. Indeed, there was a famous case study some decades ago where a board elected to take that strategy, and because of the size of the losses that were being taken, even though there were profits on the other side of the assets in that base currency going up, the cash flow loss meant that the whole board had to resign. So it's not a panacea, and indeed it's not going to be ideal where you have a significant weakening base currency.
What in practice does an active or dynamic hedge look like?
Well, as I mentioned, the cyclicality inherent in currencies means that there is going to be a time where it's going to be beneficial to increase that hedge ratio, and times where it's going to be possible to reduce it, and that will extract value over and above either having a passive or a static approach. So neither an unhedged position nor a fully hedged position is going to be optimal all the time, and the notion of having an active or a dynamic movement of that hedge ratio over time should theoretically give you better results, and we believe with our strategy in practical terms can deliver value over and above a static approach.
What techniques do you use in deciding how to adjust the hedging of currency exposures over time?
We have developed models to look at individual currency pairs and divine the direction of that currency pair, which then informs the direction of the hedge ratio over time. And we can aggregate those for any clients depending the weightings that they have to different currency pairs, and therefore effectively manage risk in that portfolio in a very bespoke and customized fashion.
Now, I'd like to touch on the issue of emerging market currency exposure and how to approach the question of hedging in that context. What's your advice there?
There has been a different approach to emerging markets by many institutions on the basis that in many cases the investment into emerging markets is not only a function of the expected return on capital of the local asset, but also the benefit of typically a higher yielding currency or a cheap currency in emerging markets appreciating over time. And therefore there's an oft-held idea or belief that no hedging is necessary in emerging markets, not least because also it can be quite expensive. The evidence, though, is that there are times of feast and the times of famine, and there have been many times in the last 10 or 20 years where adopting that strategy has led to enormous losses as emerging markets have weakened against some of the developed countries or currencies in which investors hold their portfolios. So our belief is you want to be selective around emerging markets with a base approach to have exposure, but as we like to say, have the yield when the regime is appropriate and have the shield when you want to hedge against those emerging market currencies depreciating. So that approach is something we would promote and suggest, particularly for emerging market exposures.
So, Mark, if I understand correctly, are you saying that there should be a similar approach to both developed and emerging market currency exposure, or would you recommend a different approach in the case of emerging markets?
Slightly different in the sense that the benchmark upon which one would start and be measured against would be an unhedged benchmark. So if you like, the default position would be exposed to emerging markets. Whereas in developed markets, depending on the risk culture and the objectives, you may want to choose something where it's a 50% or some other variant away from either of the extremes. Emerging markets, perhaps you want to have an unhedged benchmark as an approach and have that yield shield approach to protect in those periods where you're looking to guard against periods of emerging market depreciation. Because ultimately, a hedging strategy is all about risk mitigation and avoiding significant drawdowns and large losses.
So Mark, what final words of advice would you offer to institutional investors contemplating a currency hedging strategy?
Well, I think conceptually the way to think about the problem is that things change in financial markets all the time. And in the same way that one would adjust one's asset allocation in equities, fixed income, sector choices, credit, alternatives and so on, acknowledge that currencies are going to evolve over time, and there can be a better solution by adjusting that hedge ratio rather than seeking for the Holy Grail, which simply doesn't exist. And in our case, we're running a substantial multi-billion-dollar pool of assets looking at mitigating that drawdown from currency movements and therefore applying a dynamic hedging strategy so to do.